Thank you very much, Andrew, Paul, and Tim for the kind words of introduction. As Andrew mentioned, I'm Citi's chief UK economist, since 1st of August, based in Frankfurt, which is a bit of an odd thing, and not the only German on the podium tonight, this morning as well. And I'll leave you to figure out who the other hidden agent on the podium on the podium is. But yeah, as Andrew mentioned, we've contributed the opening few bits of the Green Budget, as we did last year. Last year we had two chapters, one on the global outlook and one on the UK economic outlook. This year we split the UK outlook into two, and those are the two chapters I'm going to speak about now. The first is on a more sort of backward-looking part on UK economic growth since the EU referendum to now. And the second chapter is the forward-looking part. But forward-looking at this point is a much more difficult exercise than it was a year ago. A year ago we had a pretty clear base case, which was a smooth Brexit, that there would be some sort of deal and then a transition period afterwards, and we were talking about risks around that, in particular the no deal risk. That was what we were doing a year ago. Right now, having a base case is a much more difficult exercise. The scenarios keep multiplying, so we have in this third chapter picked four scenarios which we think are the most plausible ones right now. And as Andrew mentioned, you unfortunately can't separate Brexit scenarios from political scenarios anymore. Or I say unfortunately, actually, it kind of makes it easier to forecast some of the dynamics that in these various scenarios would actually unfold. But let's get into the middle of things. So now the Green Budget turns blue, because that's Citi's color. Starting with the UK economic outlook. Missing out. The UK economy since the referendum missed out on a bout of growth which we saw globally, which happened to happen exactly after the 2016 referendum. China stimulated its economy in 2015, which then led to a globally synchronized boom for a while in 2016, 17, and 18. And the US, the other big part of the global economy, stimulated its economy 2 years later in 2018 with big tax cuts and spending increases as well. And those two big policy pushes to growth drove the global economy into a period of synchronized and strong growth, which the US, China, Europe all benefited from, except one, the UK. The UK missed out. In absolute terms, UK growth didn't really actually do very much. It was sliding downwards before the referendum and kept sliding down afterwards with a bit of wiggling back and forth. But that's pretty much what UK growth did over that period of time, which, you know, in isolation doesn't even look that bad, but it missed out on a growth push due to China and the US in 2017 and 18, and that's where the gap opened up. Now, comparing our forecast this year to or the numbers this year to the ones that we had last year. So last year we expected GDP growth in 2018 to be 1.3%, followed by 1.5% this year. The latest figures are that GDP last year expanded by 1.4%, so very slightly more than we had expected at the time of the Green Budget 2018. But this year, the current numbers look like growth is going to be closer to 1% than 1.5%. So we were too optimistic last year about this year. If you break it down by expenditure category, so parts of GDP, private consumption once again turned out to be more resilient than we had expected. We had expected 1.1% growth last year, 1.4% this year. The latest data suggests it was 1.7 last year and is probably going to be 1.7% this year as well. Public consumption was weaker than expected last year, but is likely to be stronger than expected this year, 2.5% growth. We had expected 1.8. So overall, roughly in line with the expectations, but with a bit of a twist. Where the weakness comes from, so the disappointment, is mainly investment. And in the next part of this presentation, that's going to be the focus as well. So in particular, business investment, we had expected to be weak, to only expand by 0.5% last year and then minus 0.2 this year. Turns out it was already negative last year, and it's much deeper negative this year than we had expected. So that's where part of the big disappointment came from, and that we blame to a large degree on Brexit. Residential investment was roughly, I mean, given the numbers are very large and swinging around a lot, I would say it was roughly in line with expectations. The other big disappointment was in exports, or is in exports. Last year, we expected a rebound in export growth in 2019 from minus 0.7 last year to 2 this year. Turns out last year wasn't quite as bad as we had feared, but this year looks much worse than we had hoped. So that's a big shift. By contrast, import growth was actually somewhat stronger than expected, which is a bit surprising given that exports were weak and business investment was weak. So it suggests that the resilience in consumer spending fed through to stronger imports, because a lot of what is consumed in the UK is ultimately imported from somewhere. So the broad message is 2019 looks weaker than expected. But if you look at the mix, there's more resilience than we had anticipated last year in private consumption and to some degree in public spending. But there's bigger weakness than anticipated in business investment, which we blame on Brexit, and in exports, which probably has nothing to do with Brexit, but with the fact that the global economy slowed quite a lot due to trade wars and China's rebalancing. As I said, business investment is the focus of a lot of the work that went into the green budget from our side this year. And more or less, the entirety of Chapter 2 is dedicated to this standout weakness in the UK economy. Now, this chart compares business investment growth, or it's slightly different measures for each country actually, but what we interpret as business investment growth in the US, Germany, and in the UK. So prior to the referendum, you can see that the UK was performing at the top of this sample of 3 countries, roughly. Since the referendum, there's been a flip around where the UK is now the weakest link, and Germany and the US more in line with each other, having quite strong investment growth in recent years. So in Germany and the US, business investment is rising by on average 5 to 6% per year. It has been rising by that rate since the EU referendum. In the UK, it's been more or less flat, and that conceals a still fairly resilient growth rate at the beginning of the sample, and that turning deeply negative since 2018. So that gap between US and Germany and the UK gives you a first estimate of the gap that Brexit has opened up in business investment. Now, this gap we can also illustrate with using some methodology from the Bank of England, which we've taken and applied to more recent data and updated. Now, what this chart shows is what business investment has been doing after recessions between 1970 and 2008, so between really the start of data collection on this and the global financial crisis on average. That's the blue line with, if you like, a min-max band around that. That's this gray area around this chart. So after a recession, as you would expect, business investment falls by, at the trough after 10 quarters, 10%, and then it starts recovering, and it starts recovering more quickly the further away you get from the actual crisis moment or recession moment. And then you have this red dashed line, which is what happened after 2008 to now. And you can see that initially the downturn in 2008 was much deeper than normal. So instead of a 10% decline after roughly 3 years, you had a 20% decline after a bit more than 1 year. So, global financial crisis, as you would expect, had a bigger impact on business investment than the previous smaller recessions had. But after that, actually, business investment fairly quickly reconverged with historical recoveries up until the moment of the EU referendum in 2016. From there onwards, you have a huge divergence between what business investment would have done in after previous recessions and what actually happened. So there was actually, as I've mentioned already in the chart before, no growth at all in business investment since the EU referendum in 2016. So we're still 10% above where we were in 2007 before the global financial crisis, whereas previously, according to previous trends, you would have expected business to go all the way up to 50% above the starting point. So that gives you another measure of this investment gap. You could argue somewhere between 30 and 40%. But even if you say, previous recessions may not be a good yardstick to what this one would have produced, if you just extrapolate trend investment growth into the EU referendum further, which is this pointy line there, the red one, even then you see a big gap opening up. So had investment just continued to grow in at the same rate as it was into the EU referendum, it should now be about 20%, 15 to 20% bigger than it actually is. And this weakness in investment is something quite dramatic ultimately for the long-term economic outlook, because business investment is demand or output now, but it's also supply in the future, right? It creates the capital stock that workers in the future, the machines, the technology and everything that workers in the future use to produce goods that make them more productive. And if that capital stock doesn't grow at the normal rate, productivity remains low, the output potential of the economy remains low. So this is something that will stick with the UK economy for a long time potentially, and perhaps even more importantly, at least from my little German perspective, it also reduces competitiveness of the UK. Because if you imagine a factory in the UK, which for the last 3 years, because of Brexit uncertainty, hasn't really invested into new machines, and is perhaps part of a multinational corporation which has invested in other factories, the productivity in the other factories has gone up during that period. Workers there are more productive. UK productivity has not gone up. So when it comes to decisions about future production lines, future products, electrical cars, these sorts of things, UK factories will relatively look less productive. Up to now, that may have been offset by weaker sterling, but whether that lasts into the future remains to be seen. So a key question in all of this is this gap in investment going to be recovered eventually or not? And I'm going to talk about that when it comes to the Brexit scenarios. But before that, it's also worth pointing out or highlighting the work that we've done, again using some methodology also from the Bank of England, on why business investment is so weak. So business investment is weak because of Brexit uncertainty. This uncertainty index that we have here, which is this blue line in this chart, uses various measures of uncertainty from financial markets and from survey data, for example, and puts them together in a UK-specific uncertainty index. And against that, you have got business investment, inverted scale, so you can see how business investment tends to follow uncertainty. Uncertainty has a strong impact on business investment in the UK. Now, this business uncertainty that we're seeing, in the UK, is a very special kind of uncertainty. Especially this year, it's become very different from usual uncertainty because it's deadline uncertainty. Right? So we had a deadline on the 29th of March. We had another deadline on the 12th of April. Then on the 22nd of May, potentially we would have had one, which then didn't materialize. Now we've got the 31st of October, and there's already legislation, which makes it quite likely that we have another deadline, perhaps at the end of January. All these Brexit deadlines. Now, deadlines have the characteristic that they lower the cost of waiting for investors, perhaps also for households, or conversely, they increase the option value of waiting for investors. So you hope that after the deadline you will have certainty what the general situation is going to be, which if you have to make large and perhaps irreversible spending decisions, becomes something which is very much worth waiting for. If it's only a few days or a few weeks or even a few months away, whereas if it was at some point in the distant future, or you wouldn't know when it would be resolved ever, you would probably ignore, right? So this uncertainty this year in particular is becoming not just high, but it has a new quality to it, and that's this deadline uncertainty, which raises the option value of waiting or lowers the cost of waiting, and that's what's weighing on business investment. Finally, on this question of the cost of Brexit. Now, last year, we spent a lot of time on comparing the forecasts that were made immediately after the referendum about the trajectory of the UK economy to what actually happened. And the conclusion we made was that at the end of 2018, the economy was likely to be exactly the size that the average forecaster right after the referendum predicted. So forecasts were right, experts were right after the referendum, that was the conclusion, but we highlighted that that was the result of two offsetting forecasting errors. Experts, forecasters had been wrong right after the referendum in predicting a recession or stagnation immediately. That did not materialize. The economy immediately after the referendum performed much better than expected. But they had also been wrong in predicting that after that recession there would be a quick rebound. Instead of a rebound, we actually had a long period of weakness, of slowing growth. So, forecasters were spot on. They got exactly the forecast right, but only because they made two forecasting errors which offset each other. That was the conclusion last year. Now, this year, we can update this analysis and add another year to it, and you have to say that forecasters were too optimistic right after the referendum because the economy keeps underperforming what we thought it would do after the referendum. So the red line, realized GDP, keeps diverging from the dark blue line, which was the Bank of England's forecast after around the referendum. Well, that's actually before the referendum. So the cost of Brexit keeps growing. Last year we thought it was about 2% of GDP. Now we think this year it's 2.5% of GDP, or GDP could be 55 billion euros, not euros, sterling, sorry, Freudian slip, pounds bigger than it actually is. What we add this year is, which last year we only alluded to, is the analysis of the, many things happened since the 2016 referendum, which we couldn't and didn't predict. And one of the things that happened was, which I already mentioned, there was a strong growth spurt in the US and Europe, which we didn't expect at the time of the referendum. And had the UK reacted to that as it normally would, then UK growth wouldn't have just been what we thought it would be, but it would actually have been higher. And we do this in this piece by replicating the UK economy using other economies which behave in a similar way to the UK economy. So we create a doppelganger economy. I like that word because it's a German word. It means a twin of the UK economy, which performs like the UK economy, but it doesn't have any of the idiosyncratic shocks that just hit the UK, including the EU referendum vote, for instance. And that gives you this light blue line in this chart, which actually would have suggested that growth should have been stronger than what we had expected before or what the Bank of England in this case expected before the referendum. If you add that, then the UK economy at this point in 2019 should actually be 3% bigger than it actually is, which means there's 66 billion worth of annual output, which are not happening, which could have happened had there not been the vote to leave the EU on the 23rd of June 2016. Now, finally, we get to the outlook, which means we get to talk about Brexit. And as I mentioned, there's plenty of scenarios out there, but we boil it down to 4. In a minute, I'm going to show you how these scenarios we think affect the economy, but I want to describe the 4 scenarios first so that you have an idea of what we're actually talking about, because the assumptions obviously matter a lot in what you model then afterwards. What we treat as base case at Citi, because I don't just have to forecast Brexit, I actually have to, for instance, forecast what the Bank of England is going to do next, and I have to make some assumptions, some base case. The base case that I have is that what we have at the moment will just continue. So we'll have an unstable government. Even if there's an election, there will be more delays to Brexit, rolling delays. There would be some fiscal loosening because all parties seem to be keen on doing that, and we shock our model economy with 1 to 2% of fiscal loosening, and we assume that monetary policy, so the Bank of England, will keep all its policy rates, policy settings steady. So that's our base case. Alternative to that is that we get a deal, so the UK and the EU agree on the terms of withdrawal. Then you get a 1 to 3 year transition period during which negotiations about what comes after the transition period continue. So there would still be some uncertainty about what comes afterwards. You would still get some loosening of fiscal policy, but you would get a slight tightening of monetary policy. So we think the Bank of England would make good on its guidance and start hiking interest rates slowly. No deal, a scenario which we already had in last year's Green Budget, now looks less bad than a year ago. So a year ago I would have said I'd probably shave 5% off my GDP forecast over 2 to 3 years. You will see that we now have a smaller number for that. The important difference to a year ago is that no deal does not happen in isolation anymore. I have a pretty clear idea of what the political scenario around no deal would be. It would involve a conservative government, the current conservative government, and we have a lot of ideas of what this government, for instance, would be doing in terms of fiscal policy. We have some idea of what it would do in terms of regulation. We know that they would be trying to strike free trade deals with third countries, including the US perhaps. It would be relatively low tariffs regime. So we have a lot of ideas now about what a no-deal political scenario and policy scenario could look like, which we couldn't anticipate a year ago. So in a no-deal scenario, our assumption is we have a conservative election victory, and then no deal perhaps at the end of January. We know that there's some preparations in place for Brexit that reduces in particular the risk of financial turmoil. We get fiscal loosening, and the Bank of England starts cutting interest rates and restarts QE. That's the no-deal assumptions. And then there's a fourth scenario, which a year ago we wouldn't have even put in a presentation like this because we thought it was so impossible, so unlikely. But if the current government has managed one thing, it's the impossible of uniting all sorts of opposition and rebel factions within Parliament, that it no longer looks impossible that Brexit won't happen at all, whether straight revocation or via a second referendum. So here we make the assumption that there would be an election, the Conservatives lose it, some form of Remain alliance centered around the Labour Party replaces the government and ends up calling a second referendum with a Remain victory. That no longer feels very, very unlikely. That feels very plausible. It would be accompanied by significant fiscal loosening as well, somewhat offset by higher taxes that Labour has. We'd have to look at the Labour programme specifically, but a key assumption here is that we wouldn't get an outright Labour majority, but a kind of coalition arrangement. So not all of Labour's policy pledges would be implemented in full. Some nationalisation, some labour regulation, but watered down. And we would expect the Bank of England to tighten policy and hike rates a bit faster than under the deal scenario. So these are the assumptions. Now that's what our model simulations give us. So the line up until 2019 is what growth did so far, and then you've got the four scenarios. Each has one line here. It doesn't look huge, the variation, but from the top scenario, which is the no Brexit scenario, where we think the deviation from the baseline would be plus 1.7% GDP in 2022, to the worst scenario, which is the no deal scenario, which would reduce growth compared to the baseline by 2.6%. That's very important because I said last year we had 5% GDP hit from no deal scenario. Now we have about half of that as a shock, due to what I just mentioned. Improvements in that particular scenario. But that opens up a span between the top scenario and the bottom scenario, which is somewhere between 4 and 5% of GDP, or in today's GDP terms, somewhere between 80 and 100 billion sterling difference in the size of economy due to the Brexit scenario, but very importantly, also the political assumptions that I make. So I could, and I do in this chart, call this the difference between no deal and no Brexit, but I could also call it the difference between a Labour government and a Conservative government as an outcome, under assumptions that they take certain decisions on Brexit. I think that's a remarkable result. That's what the simulations give us. A deal is still better than what we have in the baseline, but not much. It's only 0.8% better. So that's the scenarios that we outline in this third chapter. With that, I conclude my part of the presentation, and I hand over, I think, to Isabel. Thanks.